You make money, you pay taxes. That's the reality most investors have become accustomed to. Although there are many tax planning techniques a financial advisor can use to reduce your taxes, some advisors only have one plan in their playbook for that. Make less money, pay less taxes. You could spot those advisors because when markets are looking good, they never talk about tax planning. It's only after a brutal year like 2022 that they bring up tax loss harvesting as the silver lining for your lower account balances. Now, don't get me wrong, tax loss harvesting is a great tool. If you're not familiar, it involves selling an investment when its price has dropped below what you paid for it to reap any of the following three benefits. 1. It allows you to reduce taxes from successful investments you sell to gain. 2. It allows you to reduce taxes on some of your ordinary income, like wages from your employer. And 3. To the extent you max out benefits 1 and 2 in the current year, you can bank your excess losses to reap benefits 1 and 2 in future years. Sounds like a great tool, right? But if you, like some financial advisors, think you can only tax loss harvest in bad years, let me show you another play you can add to your playbook. It's called direct indexing. If you haven't heard of direct indexing, you may want to check out my 101 introduction video on the topic, linked here. In summary, it's an investing technique where a portfolio manager helps you directly own a collection of stocks you are interested in, instead of indirectly owning products like ETFs and mutual funds, which own those stocks as their underlying investments. Although direct indexing has many benefits, in this video, we'll focus on just one: how it can help you with tax loss harvesting through both rain and shine. To illustrate, let's consider how direct indexing could help in a great year for the markets like 2021, when the S&P 500 grew by 27%. If you invested in the S&P 500 at the beginning of that year using an ETF, your account balance would have grown about 27%. But from a tax loss harvesting perspective, there would be no losses to harvest. And even if you'd split up that original investment across the 11 sectors of the S&P 500 through 11 different ETFs like this, your average 27% gain across the portfolio still wouldn't have any loss positions to harvest. It was a great year across sectors. However, if you step beyond indirect ownership of the S&P 500 through ETFs and instead use direct indexing, you could have owned the individual stocks of the index in a portfolio that looks like this. This graph shows the performance of the approximately 500 stocks in the S&P 500, sorted from the worst performers on the left in orange to the highest performers on the right in blue. By directly owning the stocks of the index, this portfolio can track the performance of the S&P 500, just like an ETF or mutual fund, in this case resulting in 27% growth. But, unlike ETFs and mutual funds, this portfolio can harvest those individual loss positions in orange. This is the beauty of direct indexing. You aren't limited to tax loss harvesting in just the bad years. I hope this illustration is helpful, but to clarify, this is just a simple application of direct indexing. And of course, just like ETFs and mutual funds, there are risks to be managed, such as market volatility and tracking error. In my day job as a portfolio manager, I help clients manage those risks while implementing direct indexing with more advanced tactics and strategic use of sampling techniques, index selection, and continuous monitoring for tax loss harvesting opportunities whenever they arise, not just at year end. If you want to learn another advanced tax planning technique for your investing playbook, check out my video linked here on a strategy that can help reduce taxes on dividends without reducing dividends. And if you're always looking for opportunities to get smarter on investing, retirement, and all things personal finance, click on my firm's logo here to subscribe to this channel and see more of this type of content I post weekly. Until next time, it's been a pleasure, as always. Thanks for watching.